Good day, ladies and gentlemen, and welcome to your Employee Benefits Broadcast Conference Call. At this time, all participants are in a listen-only mode. If you should require operator assistance at any time during the program, please press star then 0 on your touch-tone telephone. I would now like to introduce your host for today's conference call, Ms. Kathy Azawa. You may begin, ma'am.
Hi. Hello, everybody, and thank you very much for joining us today. And we're going to be giving you the benefits news that you need in 60 minutes or less. Before we get started, I just want to start off with some housekeeping issues. So if you need any technical assistance during the call, please call this number, 866-493-2825. If you're having problems hearing the conference, just dial *0. Also, during the presentation, if you have questions for any of the speakers, please use your pull-down Q&A menu at the top of your screen. We also encourage you to maximize the PowerPoint to be the full screen, and to do that, you just simply need to hit F5 on your keyboard. And as always, you can print a copy of this presentation, and you just simply click on the printer icon in the lower right-hand corner, and then that converts this presentation to a PDF, and then you can just print it as usual. So today's topics, there are 3 of them. I will be starting off with headline news, and that's just a short discussion about the healthcare reform summary of benefits coverage and uniform glossary, which is a new disclosure requirement for plans. Then Andrew Greger, who is an associate in our San Diego office, will talk about fiduciary fundamentals, the year-end amendments and the actions that plan sponsors should be thinking about before the end of the year. And finally, we'll wrap it up with Lee Riley, who is a partner in our Milwaukee office, to talk about the Brave New World, the proposed benefits legislation that is floating around. So with that, we'll start with a discussion about the healthcare reform summary of benefits coverage and uniform glossary. So why is it that we have this new disclosure requirement? And I really think that this is one of the good things from healthcare reform. The purpose of these regulations is really to help employers and employees more easily understand a plan's benefits and costs. And I think this is especially helpful for those smaller employers who might not have the luxury of working with sophisticated benefits consultants who will help, sort of massage and manage the responses to RFPs to make it sort of an apples-to-apples comparison. And then also I think it's very helpful to employees because oftentimes during open enrollment or when they start a new job, they'll have hopefully many different health plan options, and they're sort of wondering, well, which one is the best one for me? So I think this SBC is a good start on helping people understand what those benefits are and how much things are going to cost. So the next question is, who's affected by these new disclosure requirements? And it really pretty much affects everybody. It affects insured and self-insured plans. It affects ERISA plans and those non-ERISA plans, so that would be church plans and governmental plans. Grandfather status does not give you a buy on these requirements because they apply to both grandfathered and non-grandfathered plans. And also importantly, they apply to individual health care policies. So again, I think it's a really good step in helping people better understand what exactly their plans provide. So now we're going to get into exactly what has to be included in the summary of benefits and coverage. Well, first of all, just to make it more of an even playing field, everybody has to use uniform definitions, so everybody speaks the same language. The SBC also has to provide a description of the coverage that is provided. And of course, that would include a description of any exceptions, reductions, and limitations in the policy. Also, too, there has to be a short discussion about the renewability and the continuation of coverage provisions, or the COBRA provisions. Also, there would have to be a description of the cost-sharing provision. So exactly what is this policy's deductibles? What's the coinsurance requirements? How much is a copay if I go visit my doctor? That all has to be explained. There also has to be included a statement to people so that they realize this SBC is really only a summary, and that for the real terms, they need to look at the plan, the policy, or the certificate of insurance to really understand the details of the policy. And so therefore, the SBC must include a telephone or an email address so that people can actually request a copy of those documents, the plan or the certificate of insurance. Now, if the a medical plan option has multiple provider networks or perhaps a prescription drug formulary, then the SBC also has to include an email address or some contact information so the individual can access or get a copy of those network providers or the formularies as well. The uniform glossary has been composed, and it's available at this DOL website at the address here on the slide. Also, of course, the SBC has to tell employees and employers, well, how much is this going to cost? And I think it's interesting right now because the agencies have actually asked for comments on whether this premium amount, should that be the total cost, so that would be the employer plus the employee cost, or should it just be the net cost that would be applicable to employees? So that's still an open question. Another, I think, interesting aspect of these SBCs is these things called coverage examples, or they're referred to as coverage facts labels. And maybe it's just because of the term labels, but it makes me think of, you know, the nutritional sort of readout labels on the sides of, you know, packages of crackers or, you know, whatever food that we have. At one glance, it's a quick template to tell people what's the nutritional value in this particular food. Well, I think these coverage examples are very similar to those food labels because the purpose of these examples is to tell the reader exactly what service is covered and what are the applicable cost sharings that applies to this policy. And right now, there are 3 sort of medical events that have to be covered in these examples. And it's pregnancy, the treatment of diabetes, and also breast cancer treatment. And the people for individual policies, the SBCs, they get a waive on the breast cancer treatment. Now, on the Health and Human Resources website, the HHS website, there is guidance about how it is that you actually come up with information to complete these examples. It's also contemplated in these regulations that the agencies may require additional sort of medical events in the future. So, but there is a cap of no more than 6 examples that would have to be provided in the SBCs. Also, too, in 2014, that's a watershed year only because that's when the state insurance exchanges are going to be up and running. And so when that happens, then the SBC has to include a statement on whether or not the plan provides minimal essential coverage. And this is important because some individuals may be eligible for tax credits to help them buy coverage through the insurance exchanges. But if a plan or a policy offers affordable minimum coverage, then that individual would not be eligible for the tax credits. So that's why the inclusion of this statement will be important in 2014. The regulations also go into quite a bit of detail about what should the appearance of these SBCs be. And they say that they can't be more than 4 double-sided pages. And they must be in at least a 12-point font so that they're easily readable. Excuse me. And fortunately, templates have been provided, and they're available at this DOL website. Also, a copy of them are included at the end of this presentation. And there are 2 versions of the template. One is a blank template, so the answers haven't been filled in. Excuse me. And then a second template is provided that has been completed, so you sort of get the feel of how these things are supposed to look. And, of course, there's a uniform glossary as well. So who exactly created these templates? You know, who had say in about what these templates would look like? Well, they were created by the agencies in consultation with the National Association of Insurance Commissioners. And there actually were stakeholders from many different perspectives. There were stakeholders from the consumer advocacy organizations, health insurance companies, healthcare professionals, and also patient advocates who, you know, covered many interests, including those representing individuals who are more comfortable speaking a foreign language. There is a foreign language assistance component to these new disclosure requirements, and for that, we're following the foreign language assistance rules that have already been disclosed in the Healthcare Reforms Claims and Appeals rules. Those foreign language assistance rules apply here as well. And so what that means is that foreign language assistance is going to be required if the employees reside in a county where more than 10% of that county's population speaks the same foreign language. And for this purpose, there are 4 foreign languages that are recognized: Spanish, Chinese, Tagalog, which is the language spoken in the Philippines, and also Navajo. Now, oral assistance must be available. So this could be in the form of, for example, a telephone hotline so that an individual could speak to somebody in his, native language. Also, I know that some employers and TPAs are gearing up for this oral assistance by means of actually hiring third-party translation services for conference calls. So this would be a 3-way conference call with the employee, the translator, and then somebody who represents the plan. Also, keep in mind that written translations of notices or communications are also required when they are requested by the individual. So when exactly do we have to roll out these SBCs and the Uniform Glossary? Well, the target effective date is next spring, so it's coming up quickly. It's March 23rd of 2012. But I have a question mark after that just because it seems like an awful lot has to happen between now and next spring. For example, the public comment period on these regulations just ended last month on October 21st. So the agencies are going to be able to, sort of digest all of these comments and then revise the templates accordingly. But the thing I'm sort of curious about is that the agents asked for many requests on the comments on many different issues. So it will be interesting to see if the March 23rd, 2012 effective date will really happen. So the next question is, well, when do you have to provide these SBCs and the Uniform Glossary? Well, they have to be part of your open enrollment packet. So that's just going to be sort of standard procedure, beginning next year. Also, too, if there is an automatic renewal, and I think this is more sort of applicable for the individual market, and this is when no new written materials are distributed, then the SBC and the glossary has to be provided no later than 30 days before the first day of the new policy year. Again, the SBCs and the glossary have to be available upon request. And the general rule is they have to be provided as soon as practicable, but no later than 7 days following the request. So this would be upon application for coverage or request for information. Also, HIPAA special enrollees have the right to ask for SBCs and glossaries. And a HIPAA special enrollee, just for background, would be an individual who waives coverage under his employer's plan because at that time he actually had coverage elsewhere. For example, maybe he was covered under his spouse's employer's plan. But then somehow for various reasons during the year he loses that other coverage, and so he'd like to then enroll in his own employer's plan. He then becomes a HIPAA special enrollee that would allow for that mid-year enrollment. Also, if there's any kind of change after the SBC has been initially provided, then a second SBC that includes that changed information has to automatically be sent. So again, that's something that one would have to keep track of, and hopefully I think it will discourage any changes in the SBC information. Now, the agency certainly recognized that this is a really big disclosure requirement that's now being foisted onto employers and insurance companies. And so there are some built-in protections within the regulations that are intended to prevent unnecessary duplication of the distribution of SBCs. So, for example, if an employee and his dependents all live at the same address, only one SBC is required to be distributed. But if dependents live at different addresses, and I think this is going to be much more frequent now with healthcare reform's coverage of adult children, then a second SBC must be sent to that second address as well. For renewals, keep this in mind that you only need to provide the employee with an SBC with respect to the benefit package in which the individual is currently enrolled. So it sort of gives him the lowdown on the option that he's already picked. But certainly an individual or an employee can request an SBC for any other benefit package for which he is eligible. So again, it's to encourage that sort of apples to apples sort of comparison so people can better choose the right health plan for them. Also, there is an advance notice requirement, and that's when there's been a material modification to any of the SBC information. So if there is any change in the SBC contents, then the notice has to be provided at least 60 days in advance of that change's effective date. And what exactly is a material change? Well, a material change is any change that a participant would consider to be an important change. So again, that's sort of subjective, and probably people are going to be on the rather cautious side of determining what exactly is material. So the next question then becomes, how exactly do you distribute these SPCs and glossaries? Well, of course, keep in mind, SPCs, they always have to be provided free of charge, and that applies to the glossary as well. You can never charge an individual for these documents. Always, paper copies are always an acceptable means. Again, they have to be included in the open enrollment materials. And they can be provided electronically, and if they are, though, plans that are subject to ERISA must comply with the DOL's electronic disclosure safe harbor. I personally have some questions as to whether or not this safe harbor is really that helpful because of the many requirements that it imposes. For example, you have to get everybody's consent that they're okay with receiving documents electronically, and that consent can be rescinded at any time. And so that's just a couple of the many requirements attendant to the safe harbor. So I'm wondering how useful it really is for employers. Also, too, when these regulations were drafted, certainly the agencies were aware that there's already some state laws out there that require something very similar to SBCs. So I like to think of these federal regulations as sort of setting the minimum threshold of information that has to be provided. So that means that these SBC regulations, they do not preempt existing state laws, and so certainly states can require more information to be provided on the SBCs. But it does, the federal law does preempt any state law that would require less information than what is required in these regulations. So what happens if you don't comply, that you don't provide the SBC or the glossary? Well, it can be kind of ugly. There's a $1,000 penalty for each willful failure, and that means applicable for each enrollee for willfully failing to provide the SBC or the uniform glossary. Now, the DOL and the IRS are putting their heads together to sort of coordinate how these fines on group health plans that are not maintained by a governmental employer are actually going to be levied. And also in the future, the Department of Labor is to issue regulations regarding procedures for how to assess these civil fines against employers. But until further notice, group health plans must continue to sort of self-report that they've screwed up and pay the Internal Revenue Code's $100 a day excise tax on the Form 8928 until further guidance is actually provided. So with that, I'm now going to turn it over to Andrew, who's going to be talking about fiduciary fundamentals.
Thank you very much, Kathy. Today I'm going to talk to you about some year-end amendments and actions that you're going to need to take by the end of this year and into the beginning of next year. Let me pull over my slide here. So we've got about 7 or 8 things we're going to talk about today. We've got some Code Section 436 amendments for defined benefit plans, a cash balance plan amendment, which the deadline for which has actually been pushed back, so we don't have to make those this year, but we're going to talk about them a little bit. 2009 required minimum distribution amendments, which are amendments that relate back to 2009 but aren't required until the end of this year. For any plans that allowed an in-plan Roth rollover conversion, those amendments need to be made by the end of this year. PPA amendments for governmental plans by the end of this year. Control group election for determination of their filing purposes is something that you can make if you so choose up through January 31 of 2012. And then we've got a couple more Affordable Care Act deadlines along with the summary of benefits and coverage that Kathy just spoke about, including W-2 reporting for cost of health plan coverage. So for Code Section 36 amendments, the Code Section 36 was added by the Pension Protection Act, and it restricts lump sum distributions and certain other distributions and benefit accruals if a plan's funding percentage drops below certain levels. Code Section 436 was originally amendments for it were originally to be put in place by the end of 2009, along with other Pension Protection Act changes. But in October 2009, and in October 2009, Section 436 regulations were issued, which were to go in effect in January for plan years beginning on or after January 1, 2010. And then in December of 2009, the IRS delayed the deadline for amendments to comply with Code Section 436 and some other PPA provisions, including the cash balance plan amendments, which will be my next topic. And the delay was so amendments would need to be made until the last day of the first plan year beginning in 2010. Then, last November 2010, the IRS pushed the Code Section 436 amendment deadline back yet again to so that amendments don't need to be made until the end of 2011, which is this year, and here we are. With Code Section 436, the amendments with our clients, many clients have already made the amendments because of, especially when we didn't get the guidance of the deadlines we pushed back till December of 2009. We went ahead and made amendments. So you might want to check your plans. This amendment might have already been made. If it hasn't, though, you've got till December 31st. And when you make these funding restriction or the benefit restriction amendments based on the funding level, you want to be careful not to put too much language into the plan, because it could be difficult if you overstate the restrictions you're putting in place. It could be difficult to amend that away after it's in place. So you want to be minimalistic, I think, with what you put in. But there is a pretty hefty amount of statutory and regulatory provisions that you will need to put in place with these amendments. So again, that amendment for Code Section 36 deadline is December 31st of this year. For cash balance plan amendments, now this is something that we're actually not going to have to make this year, but by way of background, cash balance plans, as compared to traditional defined benefit plans, provide a hypothetical account balance that is the benefit that a participant will receive. And there was a fair amount of confusion prior to the Pension Protection Act regarding age discrimination under these cash balance plans, and in both there's both statutory and regulatory guidance that left uncertain some issues. So the Pension Protection Act aimed to clarify this and added some provisions in Code Section 411 regarding minimum vesting and continued accrual requirements specifically for cash balance plans. The regs for the cash balance plans were issued in October 2011 and largely discuss the market rate of return. The interest credit rates are limited. Interest credit rates on our cash balance plans are limited to a market rate of return. They can't be higher than that. And the regs discuss that, and there's been a lot of back and forth, a lot of chat amongst practitioners about what a market rate of return is and how the regs define it. This deadline was originally, the deadline for these amendments was originally 2010, but has been pushed back once to 2011 back in last year, and then now this year another delay has kicked in so that these amendments won't need to be made this year. The earliest they'd need to be made would be sometime in 2012. There are proposed regs along with part of the regs that were released for cash balance plans were proposed, and they're going to be finalized. When they are finalized, the amendments to comply with them will need to be made prior to the year that the finalized regs take effect. So if the regs take effect in 2013, which is what many people are expecting, the amendments would need to be made by December 31 of 2012, so next year. And there's also a requirement under ERISA to provide a 45-day advance notice of such an amendment. So the notice would need to go out by November 17th of 2012 if the regs have that 2013 application date, which we're not sure yet, but we'll let you know when we hear more. until the amendments are made and the final regs come out and amendments need to be made, plans do need to comply in operation with the code's cash balance requirements. Another year-end amendment this year is for the 2009 required minimum distribution amendment changes that were made. Back in 2008, the market had a terrible year, and so the IRS lifted the usual requirement to make required minimum distributions for 2009. So what they did is they gave retirement plans. This applies only to defined contribution plans. They gave them the option to either continue to make required minimum distributions in 2009 or to suspend them. And they also allowed plans to give participants the option to take their 2009 required minimum distributions or defer them. And so there are model amendments out there that sort through whether that discuss either the suspension by default with a participant option to elect to take 2009 required minimum distributions, and an option to have 2009 distributions be the default and participant option to suspend them. In either event, these amendments need to be made by the end of this year, and we recommend that you take a look at what you chose to do, go back talk to your vendors to figure out what choices you made in 2009 regarding required minimum distributions, and make sure that the amendments you make comply with the administrative actions you took at the end of 2009. Two other year-end amendment issues that are here with us are in-plan Roth rollover conversions and PPA amendments for governmental plans. For in-plan Roth rollover conversions, prior to 2010, conversions from pre-tax to Roth contributions were only allowed after rolling out of the plan into a Roth IRA, and were limited to individuals whose adjusted gross income was $100,000 or less. And also, if your filing status was married filing separately, you were not eligible to make these Roth rollover conversions. But in 2010, the income and filing status restrictions were lifted, and effective September 27, 2010, you could, instead of rolling over into an IRA to make this Roth conversion, plans had the option to allow participants to just do an in-plan rollover to convert their pre-tax deferrals to Roth deferrals. In order to be able to make these in-plan Roth rollover conversions, a plan must allow Roth deferrals, and only amounts that are eligible rollover distributions can be converted via a Roth rollover conversion. For 2011, this would just be a traditional amendment that must be made by the end of the year in which the change took effect. But for 2010, the IRS gave us a extension allowing any in-plan Roth rollover conversion amendments that took effect in 2010 to be made by the end of this year, 2011. And then for PPA amendments on governmental plans, the end of 2009 was the traditional PPA amendment deadline for all ERISA plans, but there was a specific statutory extension or delay for amendments for governmental plans for the end of 2011, this year. And control group election for determination letter filing purposes. So this is regarding the IRS has a 5-year cycle for submitting determination letters. We just finished the first cycle earlier this year in January, February 1, 2011 through January 31, 2012 is cycle A of our second 5-year cycle. I think cycles A through E are what we have. And generally, a plan's cycle A through E is determined by its EIN, the plan sponsor's EIN. And the IRS has provided an option for members of a controlled group to put all of their plans into one cycle. If in the case of a parent subsidiary controlled group, the parent of the control group can elect to have all plans in its control group subject to or put in the same cycle as the parent, determined by the parent's EIN, or in a non-parent subsidiary control group, all members of the control group could elect collectively to place themselves in cycle A. In either event, if you'd like to make this election, you should make it by January 31, which is the end of January 31, 2012, which is the end of cycle A. And Foley has some forms you can use. We've drafted some templates. So if you'd like to do that, please contact one of us. Another year-end action item is to prepare for the Affordable Care Act or the Healthcare Reform Act's requirement to report on W-2s the cost of employer-sponsored health coverage. Now, this rule was originally to take effect in this year, 2011, meaning that the cost of health plan coverage would be shown on W-2s that would be released in January 2012 for the 2011 tax year. The IRS made 2011 optional and kicked this rule in as mandatory for 2012, which means that the January 2013 W-2s are the ones that will have will be required to have cost of employer-sponsored health coverage reported. There's a new box, in box 12 there's a new code DD that will be used to report the cost of employer-sponsored health coverage. This requirement is one that grandfathered plans must meet. So if you have a grandfathered plan, you have to report it on the W-2. And in order to determine what employer-sponsored health coverage is, it does exclude coverage for long-term care, standalone dental or vision coverage, HSA and Archer MSA contributions, and most flexible spending account contributions. But I misspoke there. It excludes those amounts. So generally the way we've been looking at it is it's going to be the cost of COBRA coverage is what is going to be the cost of coverage. That is, it includes both employee and employer contributions for active employees, and so it's the higher number than just that employee contribution level. Another Affordable Care Act change that you should be aware of is the change in the restricted annual limit on essential health benefits for the 2012 plan year. The Affordable Care Act brought about eventually is going to put an end to annual limits on essential health benefits, but that doesn't take effect until January 1, 2014. From the time the Affordable Care Act was enacted until 2014, there are sliding scale of limits in place. For the 2011 plan year, you can have a $750,000 limit on essential health benefits coverage. And now going into the 2012 plan year, which is where we're about to hit, you can have $1.25 million as your limit on annual limit on essential health benefits. And for 2013, a year from now, it's going to be $2 million. Will be that limit, and then 2014, no limit will be allowed. I'm speaking a little bit roughly there. The actual changeover date on those limits is September 23rd of the prior year. So for this year, that $1.25 million, if you happen to not be a calendar year plan, that $1.25 million amount kicks in for plan years beginning on or after September 23rd, 2011. and then the $2 million amount will kick in for plan years beginning on or after September 23rd, 2012. So generally 2013 for plan years, for calendar year plan years. That's what I have for you today on year-end amendments and other action items. Please submit any questions if you have any. And I'm going to turn it over to Lee, who will talk to you about the proposed benefits legislation.
Thank you, Andrew. We decided to talk about proposed benefits legislation as our last topic because it seems that there is a lot of legislative proposals floating around Congress dealing with benefit plans. And part of what we're going to discuss, too, are some of the things being considered by the so-called super committee, which is the congressional committee that's been charged with reducing the federal budget, and how they're considering things that might affect benefit plans. So the first thing we're going to talk about is what I consider kind of the government's love-hate relationship with over-the-counter drugs, because this has been stormier than things you would see on Desperate Housewives. So if you remember years ago, before 2003, medical flexible spending accounts could only reimburse prescription drugs. So over-the-counter drugs weren't allowed to be reimbursed. Then in 2003, the IRS came out with some guidance and said, well, of course over-the-counter drugs can be reimbursed. That's not a problem. And so we all amended our flexible spending account plans to let participants submit over-the-counter drugs for reimbursement from their flex accounts, and it was a nice little benefit that was added. Then as part of health care reform, which was passed last year, the Congress said no more reimbursements of over-the-counter drugs. So we, last year, amended all of our flexible spending account plans and participant communications to tell people that, sorry, you can't submit over-the-counter drugs for reimbursement anymore. And that change was generally effective January 1, 2011. Well, as many things healthcare reform related, I think Congress is taking a second look at some of the changes that they had made in the healthcare reform bill. My sense is they pushed that bill through rather quickly, and then after the dust settled, they looked back at it and said, why did we do some of the things that we did? And this is one of those things. So there is now a bill pending in both the House and the Senate that would repeal that PPACA, which is the healthcare reform rule, provision, and would then allow, yet again, over-the-counter drugs to be reimbursed from medical flexible spending accounts. There's no effective date given in this law, so I'm going to guess as it gains momentum, they'll throw an effective date in there. It'll probably be 2013 to give us planning time, but who knows. But just be aware that we might be coming back to you and telling you that, guess what, over-the-counter drugs are reimbursable yet again, and let's amend everything yet again. Next thing that's floating around Congress that they seem to have some concern about is this concept of 401k plan leakage. Now, leakage is this concept of 401k monies being used for things that aren't retirement related. I mean, after all, the whole point of a 401k plan is to find a way for individuals to save money and for employers to contribute to people's accounts so that they can have income in their retirement years. Despite that, though, there's many times where the 401k money isn't being used for those purposes at all. And the classic examples would be loans. So somebody takes a loan from their 401k plan, never ends up paying it back. That's an example of what Congress and the Department of Labor calls a leakage from the plan. Hardship withdrawals is another thing that seems to be getting attention. Obviously, with the hardship withdrawal, you're pulling money out of your plan. There is no repaying that back. It's just a draw, and it's reducing your retirement savings. I've even seen some concerns about things like lump sum distributions, and we'll actually talk about that a little later, where Congress and people are questioning when you have a 401k plan and somebody terminates employment regardless of age and they can get their money in a lump sum, isn't that a kind of a leakage from this retirement savings, because they could, after all, take that lump sum and use it to pay off their credit card bills, go buy a boat, take a vacation around the world. That's not really the intent of 401k plans. So Congress is starting to dabble into stopping the leakage or helping the leakage or doing something to ameliorate these problems. We have two bills pending, one in the House and one in the Senate. They're identical in some ways, and then the Senate bill has some extra provisions. So both the bills deal with defaulted loans. And here is the situation that we have now under current law. So let's say I'm a participant and I have a $50,000 account balance and a $10,000 outstanding loan. I terminate employment, and at my termination of employment, I stop my loan repayments. I then walk into the plan and say, give me a distribution of my account. What's going to be reported to me as a distribution is $60,000. $50,000 will be an actual check because that represents my investments, and then $10,000 is a deemed distribution for my loan, my outstanding loan balance that I didn't pay off. Now, under today's laws, I could roll that whole amount into an IRA or another employer's plan within 60 days of getting that distribution. Now, I only have $50,000 of cash to roll over, so I could, out of my own assets, my savings account or some other means, come up with that $10,000 for that defaulted loan and add that to my rollover amount and end up rolling over $60,000. The problem, of course, is I have to do all that within the typical rollover 60-day time period. So one of the things that's being proposed, again, in both the House and the Senate bill, is that employees would actually be given all the way to their tax filing deadline to come up with that loan repayment money that they can then roll over into an IRA or another employer's plan and then not be taxed on it. So it's a nice mechanism, and to me a very clever thing, to allow participants to get that loan money back into a tax-deferred vehicle where they can, save that for retirement, which was always the intent. Now, this provision, this extended rollover rule, only applies if my loan is distributed to me in accordance with or due to a plan termination or due to my separation from service from my employer. This is not available to participants who are actively employed and then just stop paying off their loans because they can't afford it and they go into default. Wouldn't be available in that situation. I like this amendment personally because this is one of these great amendments where, from the plan sponsor standpoint, nothing for you to do. You just make your distribution in the normal course, and then the individual is the one that comes up with the money, rolls it in, hopefully will have to their tax filing deadline. So it's a great thing for participants and no work for the employer. So I like this one. The next thing that is in both bills is dealing with hardship withdrawals. And almost every 401k plan out in the world has hardship withdrawal provisions. If you've designed your hardship withdrawal provisions to meet certain IRS safe harbor requirements, one of the things you probably have in your plan is a rule that says if you take a hardship withdrawal, you cannot make contributions to the plan for 6 months. Congress apparently doesn't like that provision and wants to eliminate it. I'm guessing with the theory that, yep, I may have a hardship event like a big medical expense, or my house might maybe being foreclosed on, so I need money for that purpose, but yet maybe I can still contribute to the plan, the very next week because my contributions are little bits of money coming out of every payroll, and so why are you cutting off my ability to add to my retirement savings for this 6 months time period? So that might be something that we see coming. The Senate version of the bill has the same provisions, and again, they have two additional ones. They would prohibit 401k loans from being initiated through these credit card transactions, which I haven't seen any of my client plans that offer basically debit or credit cards as an easy way to get a 401k loan. Not surprising to me that Congress would think that's not a good idea and would cut that off. And they want to add a rule that says no participant could have more than 3 401k plan loans outstanding at any time. Now, my experience with this is that wouldn't be a change for most of my client plans because they have already designed their 401k plans to limit loans to no more than 1 or 2 at any given time. So probably not a lot of practical implications, but for plans that allow multiple loans at any given time for one person, this could be the new limit. Now, the next thing that there's only one bill in the Senate, but I think given what I've been reading from the IRS and the Department of Labor, I think we're actually going to start to see some activity around annuity payments out of defined contribution plans. Now, this is an interesting new turn in the law because if you may recall in the past, you might have had a 401k plan that was, established 15, 20 years ago, and at the time you established the plan, you probably offered lump sums, installment payments, annuities. You probably had a whole laundry list of distributions. And for years, the rule was you can't get rid of those forms of distributions. The Internal Revenue Code just didn't allow you to cut back on the forms of distributions made available in your 401k plan. Well, then the IRS several years ago lessened that requirement, and they basically said, look, if you've got a 401k or most defined contribution plans, as long as you have a lump sum, you're allowed to get rid of your installments and your annuity forms of payment. So we did that. We spent, several years amending 401k plans, and now it's not uncommon to find a lot of 401k plans where the only form of distribution they make available is a lump sum. Apparently, we're now going to go in the other direction because the Senate bill is concerned that, again, I think it goes back to this leakage problem. You've got employees, they're terminating employment, they're getting lump sum distributions, they're not using that for the retirement savings. So the Senate bill would propose a new disclosure requirement, again, applicable to account balance type plans. And what they would say is, we want you to disclose to the participants how their lump sum account balance would look if it was converted to a single life annuity or a joint and survivor annuity, assuming that the employee and the spouse were the same age. This disclosure would have to be on at least one account balance statement per year. And as you know, as a result of, again, the Pension Protection Act, most account balance plans are giving quarterly statements. And so one of those statements per year, you'd have to take that lump sum account balance and turn it into this annuity stream of payments so participants could see my lump sum, if it would be paid to me as a lifetime income, would get me this much per year. Now, this bill says, hey, Department of Labor, you need to come up with some model language because obviously whatever is presented on this account balance statement may not accurately reflect what the person could actually buy as an annuity out on the market. It's heavily dependent on the actuarial factors that are going to be used to do that conversion from the lump sum to the annuity. And so the Department of Labor would come up with model language that we would add to the statement to basically warn participants, this is, just an estimate, you can't really rely on it. Now, the reason I highlighted this one is because the Department of Labor and the IRS are also looking at this very same issue of, are the lump sums in defined contribution plans really the right thing to be doing, or do we somehow need to encourage, force, whatever, annuity forms, lifetime income streams of payments out of those plans? So this is one that even if the Senate bill doesn't, pass and doesn't go to the House, I suspect we might get through IRS or Department of Labor regulations something similar to this coming up. Now, this is great for the actuarial firms because obviously they're going to have to come up with a table or do the calculations for the plan sponsors so that we know what to put on the statement. And in many ways, I think this actually wouldn't be a bad disclosure because a lot of participants, their only savings that they have for retirement in addition to Social Security is their 401k plan account. And they're sitting there saying, well, when I retire, I think I need $3,000, a month of income to cover my living expenses. And then I have a $282,000 401k account balance. And they have no clue how to take that account balance and figure out, well, what does that mean to me as a monthly or annual income stream? And so this would help them do that analysis and then maybe notify them that they're not saving enough for their retirement. The next law that's floating around there is, again, in the Senate only, so there's no House counterpart to this one yet. And it focuses on the thing that everybody seems to hate these days, which is stock options for executives. So this bill is called the Ending Excessive Corporation Deductions for Stock Options Act. And here is what it does. It says, in today's world, if a company grants a stock option, your accountants come in and they value that stock option. And they may use the Black-Scholes method or binomial method. They use some kind of method to say that stock option is worth $100 on the date of grant. And so you, company, are going to, on your financial statements, expense $100. And if the option, for example, has a 4-year vesting schedule, we take your $100 expense and you recognize a $25 expense per year. So you spread it over the 4-year vesting schedule. So that's how it works on the company's financial accounting statements. Separately, when the individual goes to exercise the option, that normally results in compensation to them equal to fair market value and the date of exercise minus what they paid for it. Now that compensation amount could be $100, it could be $3, it could be $3 million, depending on the stock price and where it is moved from the date of grant to the date of exercise. Whatever that compensation element the employee or director recognizes, the company gets a tax deduction at that time for that amount. So there is a mismatch between what companies are reflecting on their financial statements as an expense and what they are taking as a corporate tax deduction. So this bill is going to try to align those two things. And what it wants to do is to say your corporate tax deduction can never be bigger than your accounting expense. And your corporate tax deduction should be recognized at the same time as you're recognizing the accounting expense. So it's taking all our traditional notions of when compensation is recognized, the company gets a corresponding tax deduction. That's pretty much the way all compensation works and has worked for decades, in really completely changing the rules. The other thing this act would do is say if you're a publicly traded company subject to 162M, and 162M is the rule that for your highest paid officers, you can't, as a corporation, take a deduction for more than $1 million unless the compensation is performance-based. If it's performance-based, you can always get your corporate deduction even if the guy or gal ends up making more than $1 million a year. So this law would say stock options can never count as performance-based compensation. Now, this one, and no offense to whatever senator proposed this bill, I would fit into the category of kind of a wacky law. It would be a very unusual tax law, to be honest, because it really would completely change how we think about corporate tax deductions. It also is weird in the sense that this whole mismatch between how a stock option is expensed versus the amount the company gets to take as a tax deduction, that issue applies to restricted stock and restricted stock units and all sorts of forms of equity compensation. So why this bill chooses to single out stock options is not clear to me. So I'm thinking this probably is not going to pass because it's, again, kind of weird and wacky. But on the other hand, we all know that Congress seems to hate executives and hate executive compensation. So maybe this is one that would pick up steam. The last thing I'll talk about at the federal congressional level is our super committee. The super committee is this joint committee that's been charged by the president with trying to cut $1.5 trillion from the federal budget over the next 10 years, or raising that equivalent in tax revenues. And so some of the things the super committee is looking at are things like increasing PBGC premiums. These are the premiums that plan sponsors of defined benefit pension plans pay to the PBGC so that the PBGC has some money when they have to take over, underfunded plans when plan sponsors go bankrupt or out of business. We've just recently had increases over the last few years. It wouldn't surprise me that this makes its way into a budget bill here in the near future, so be warned that we might have more premium increases coming. Another thing that looks like they're seriously considering is lowering the annual cap on employer and employee contributions to account balance plans to the lesser of 20% of the participants' pay, or $20,000. Now, the current limits are $49,000 or 100% of pay, so this would be a dramatic reduction in the contribution limits. But if you think about most Americans, and they're probably, contributing $3,000 or $4,000 to their 401k, they might be getting a $1,000 match, and maybe a 2% of employer pay contribution. Most people are probably well under this $20,000. This is probably going to hurt the doctors and the lawyers and, the accounting firms that are making big contributions, and that might make this a very interesting way for the government to raise revenue without feeling like they're hurting the ordinary worker. Now, the last couple things I just want to give you a heads up about is what we might be expecting from the IRS and Department of Health and Human Services next year. So the IRS every year comes up with their to-do list for their fiscal year and talk about what regulations or guidance they're planning on issuing. On the screen here, you'll see a list of the things that I thought were most relevant that we can be expecting. Some of the important ones are final regulations for cafeteria plans. We've been waiting on those for about 3 years now. For our tax-exempt people on the line, IRS has said they're going to give us 457F plan regulations. Of course, they've said that for the last 2 or 3 years, and that hasn't happened, but hopefully it'll come up this year. And again, note that third bullet point, which is they're going to be looking at issues related to lifetime income from defined contribution plans. That's why I said I think that's something that we will be seeing next year in either notices or mandatory installments or mandatory annuities. Something like that might be coming. And my last thing is Department of Health and Human Services at a speech recently said they were going to be issuing final comprehensive HIPAA privacy and security rules early next year, and that these final rules will do some tweaks to breach notification. They'll incorporate all the regulations from HITECH, which was a law change from several years ago that we haven't had regulations about, and talk about how the Genetic Information Act coordinates with HIPAA privacy rules. So that is what you can be expecting for next year.
Thank you very much, Lee. And I'm sorry, but it seems like we've run out of time. But if you would look, certainly, though, if you have any questions, please contact any one of the speakers. We'd be happy to be able to talk with you or email you any answers to your questions. Also, too, if you could mark your calendars for next year, we've already scheduled our webinars for next year. It'll be once a quarter, and these are the dates. Also, just thank you very much for joining us today, and a copy of this PowerPoint is available at this website. And also, too, if you could actually click onto this second website and answer a short survey, that would be terrific. Also, too, if you're trying to get continuing education credits, it's my understanding you have to actually complete the survey in order to get your CLEs. So, and here's a survey. So, thank you very much, and please don't forget that the templates for the SPC and the Uniform Glossary are available at our website or also at the DOL. And thank you very much, and we'll see you next year.
Ladies and gentlemen, this does conclude today's presentation. You may now disconnect.